folks, this trading course is about moving average strategy. Upon the completion of this course, you will learn a lot of techniques and tricks on how to use moving average in your trading. Okay, let's start. Okay, before we go to further to moving average, it's very good to have a basic knowledge of what is actually moving average. Okay, for that I have one example here. So if you look at here, I have 1 week prices of asset, daily closing prices. So it's 7 days, 1 2 3 4 5 6 7. Okay, I have written like number 1 11 12 13 14 15 16. Of course the actual price is not like this. The price has a lot of swings, but this is just for an example to make it easier to understand. Okay, so let's say that we have a moving average with the period 5 days. So 5 days is our SMA period, which you will see in most of the moving average that you have to set that period. What this basically means that is that we take 5 days price of 5 days, and then add them together and then divide that by number 5. So we start from the first day of 5-day moving average. It will be right here, right on the 15 here. So that is 1 2 3 4 5. So we add all these 50 the 5 prices together and then divide that by 5, then we get 13. Then 13 goes here, and then you see that we will not have any SMA here. That is because that is not enough data to make an average, but from here upward it will be counting for every price. For every price moment we will have a 1 point of moving averages. Okay, so let's say for the second day we will start from here. That was the first day, and the second day we go for prices up. So that was 1 2 3 4 5 6. This time we have 16 and we discard 11 because we started of the second day here. So we go all the way and add them together, divided by 5, we get 14. So 14 comes here. Okay, and then we go for the third day is here. So we will start from here, and 1 2 3 4 5. So we have 5 days here, and we come to the end here, and then we add them all together and divide that by 5, we get 15. So here it goes it will be 13 14 15. That will be the simple moving average. Okay, so that is very simple. Basically, you then what the period is, you just that number of the days, or that number of the, depending on your time frame. If for example your time frame is on 1 hour time frame, then you take the 5 hours there and add this together and then divide that by 5, and next hour you get another 5 hours and add them together and divide that by 5, or the period, whatever period is your for your moving average. Okay, so that's it. No, we wanted to know. Okay, there is so many different moving averages. I'm not gonna to go and talk about all of them, but I will just take some of them that is very commonly used. At least 2 of them are very commonly used, but one of them is mainly used by me by a specific strategy that it has been developed by myself, and that strategy is called Gailani strategy, which will that strategy will be covered by at least 5-6 videos, and these videos, these courses will come in the future. Okay, the one that I am using in the Gailani strategy is a whole moving average. This whole moving average, we call it HMA. HMA is very fast. Is the good feature. The good feature with HMA is that it's very fast, and also is calculating the volume and the movement of the price price, and which this is basically very quick can tell us if there is some changes, some changes in the order book of the asset, or the volume has been changes to the volume volume on the for this asset on the market, and these will very quick or fast and tell you okay where is the price is moving. So this is a very fast moving average, special one, very special one, which I use for my developed strategy. And then the other very common one is called exponential moving average. We call it EMA. EMA is exactly the same as the simple moving average, except that they're putting a little more weight on the latest prices, and that make these moving average much faster than the simple moving average. So this EMA is much faster than the simple moving average. So the third one is the simple moving average, which is very common, and most of the supercomputer for trading, and also these professional traders and all these analysis houses, most of them, they use these simple moving averages because that is a very common that is an indicator that is used as a common tool that will make you one step ahead to get close to the main player, and those who are basically have the power to drive the price of an asset. So that is very important. And then we have a lot of other moving averages, which I'm not gonna to mention them here, but you can look at your platform from your broker that probably have a lot of other moving averages for different purposes. Okay, so what are the features of a moving averages? What can we use the moving average for? What kind of information we can extract from the moving averages? Okay, this is the very important. So I will mention some of very important features of moving average. Okay, the first one is the momentum, gravity, and the speed. Okay, that is basically momentum of the price. How strong is that movement of the price, whether it's falling or is rising, or what how powerful it is. So the more the price are away from their moving averages, the more powerful, the more momentum they have it. Okay, the closer they are to their moving averages, they are weaker and weaker, and that means that basically there is a gravity that is pulling the price, toward that moving average, whether that is from that gravity is pulling from up, down, or pulling that down, up. So that is when the gravity is pulling the price, when that goes close to the moving its moving average. Okay, the next feature is that we use these moving averages for identifying the entry and exit points for trading. This is very common because these moving averages are giving you key areas on the chart that will help you to identify these entry and exits, and also the stop losses and targeted for your trade. The third point is a trend. Look, when we talk about a trend, always has this in your mind. The trend is based on three factors. So three things. The one, either it is an uptrend or downtrend on the reverse. We don't have more than three factors here with the trend. So just make that a common practice for yourself. When you talk about the trend, when you look in your new chart and see what is the trend, always remember these three factors. Okay, there is just three things that I have to look for it on this chart, which is uptrend, downtrend, and reverse. And that is where basically the moving average is showing you how these trends very powerful for showing you the trends. Okay, And the other things is we use these moving averages as a resistance, support and resistance level. So these levels are very, very good, but make sure that you always have those levels on the longer time period than the time period that you are entering and exiting here. That is very, very important in order to have the actual picture of the market structure of support and resistance. Yes. So the other good feature with that is that we can use these moving averages for filtering false signals from other indicators. For example, I myself I use that in the MACD for filtering the false signals from MACD. We know that the MACD indicator is generating a lot of good signals, but at the same time also is generating multiple false signals before it give you a good signal. But how we use you can use these moving you can use these indicator in moving average MA for filtering those false signals in order to use your other indicator like MACD in the optimal way. Okay. So the other one is filters noise in the price. That is the basically the beauty with the MA is basically built for that reason, that when because the price are moving, you know, we have a lot of, you know, like spike in the prices, you know, very strange, you know, movement in the prices, you know, that. So what is happening, the moving average basically help us to filter all these noise in the prices that make it very smooth price and very good information from that, which helps us to make good decision in our trading. And then the other things is 7 is a little strange compared to others. So what I wanted to say that these features are really valid if market respect to MAs. If market does not respect to MAs, so these 6 features basically is useless. They mean nothing. What we mean by market respect to MAs, that means basically when market is a good trending condition, when market is good trending condition, when that is perfect time for moving MAs to be used. But when market is choppy or in the range condition, that is very bad for the MAs. That's big because the market does not respect MAs. But when basically when market is volatile or there is high volatility in the market, and that make it that basically that's affecting all the indicator, not only MA. So the market respect to MA is we must keep that in our mind. That what that means basically, you want to look at the market conditions. If market condition is strong trend, whether uptrend or downtrend, that is, or reverse, whatever it is, but that means basically in what is called the that is good for the MA. But when market is in the range, or a market is choppy, that will not respect to MA's rules at all. So you need to avoid that. Okay. So now we have talked about what is MA, and then we talked about the different types of MA, and then we talk about their features. And now it's time to talk about about the signals that MA can give us. What kind of signals that gave us? Basically, that gives us two type of signals: bullish signal, buy signal, and sell signal. And these buy signal and sell signals, they are very interesting. That means basically, when we have whenever a price get close to MA, either that MA is a resistance or a support. So if that is a resistance and a support, then based on that, it will give us a signal. So when price get close to that MA, so we should think of that it always give us the possibility that give us two signals. Okay, so it will give signal. So either one of them, either it will give you a buy signal or it will give you a sell signal. So this is very important to know that, okay, when the price get close, well, it doesn't matter whether it is that MA is acting like a resistance or acting like a support. So when that price get close that those, there are two possibility. Either we will definitely get one signal, so two possibility for that signal, either a buy signal or sell signal. How we identify these buy signals, it depends on where the price is and whether that is a resistance, that MA is a resistance or is a support. So in the buy signal is that when that we have two types, either it will have a bullish breakout or a bounce. So bounce, one is bounce. That means basically when the price is falling, coming down, when MA is acting as a support. When MA as is acting as support, the price comes that. So there is either a breakout for the of that support, it will be a breakout. If that breakout happen, that means, okay, is a bearish signal. The bearish signals, bearish breakout, or it will bounce. So you see that we have only two alternative here. Okay, two options here, either bounce back or breakout. That means either buy or sell. And then when it goes when the price goes to a moving average, where that moving average is acting like a resistance, so what happens? Either that will break that resistance, which will be a bullish breakout. So again, we have two option two way, okay, two signals. Either it will be breakout that you have bullish, or that will bounce, that it will be resistance bounce. That means basically that price that has gone and reached the resistance, it will bounce back. So you see that basically we have two for each moment, each close to the MA, we have two, either we have a sell signal or buy signal. So that is for sure. Okay, let's show this on a chart, okay, and see how that is. Okay, folks, I have the here Bitcoin, we in the daily time frame. As you see that we have, for example, if we look at here, we have we see that this, if you look at this SMA and this SMA, this is 200, this is 100 SMA, and then when we look at the price is coming here and here, what we have it. So we have if we look at here, we have two. We will have either one buy signal or one sell signal here. Why? Because the reason for that is that basically these SMA is acting as a support here. So if we may, because this is a support, so a breakout will be a bearish breakout, a sell signal, and or it will bounce. It will have a support bounce. That means that, okay, it will hit it and go back. In this case, it has a breakout that gives us a bearish signal. It comes down to the next MA. When it comes to the next MA, again the same situation here. We have the same situation we have here, right? What we will do here is that okay, we will look at that here. There is again two possible signals here. It is either it will be a support bounce, which bounce back to to here, or that MA, or that one, okay, but or it will be a further bearish breakout, and that is continuing for the breakout. It continues and so on. So it's, if you look at here, the same here. If you look at that, it comes hit here, it is acting as a resistance, and then we have two possibility for two signals here, either a bearish signals or a bullish signals. Either it will bounce back from this resistance, which will be a sell signal, or it will break out at this point, that which will be a bullish breakout, and that is you see how what has happened here. Okay, okay, that was about these two signals, but we will come talk more about these signals in soon when we talking about how to identify the signals. Okay, we now go to the crossovers. We have two type of crossovers. One type is very common. I think you guys has maybe seen that many on many videos on YouTube. But I think the candlestick crossover is not that much. So I think this I can say that I am one of the this is the first time maybe you can hear it, and you will see, even if you have heard that, you will see that how I use it with different techniques, how powerful I am using this with the techniques that I have found. Okay, so what we have, the first one, we will talk about the candlestick crossover, and then we go talk we'll take example of the normal moving average crossover when they cross each other. Okay, so first the crossover is that reversing is that once the EMA cuts through the price, it is a signal that the trend is reversing. Okay, when it cuts the price, so whether it is from up or down or whatever, when it cut when basically the EMA or SMA moving average that is cutting the body. Listen, I am saying the body, not the wicks. Okay, the body of the candle, and that signals a reverse in the price. So whether it is from above crossing and going below, or from below crossing going above, but in either case there is a reversing of the trend. Okay, and then if they may catch the price, bullish candle, a green candle that from above and runs below the prices, that is basically a bullish signal. Okay, when it goes below this gap, and that will be basically your entry point, and that will be a signal, a bullish trend. That means the trend reversed, and now it will go up. And when the MA cuts the price, bearish candle or a red candle, okay, body from below, and then runs above the prices, that is where it gives you that is a good place for entering a sell position and signal a bearish trend. Okay, let's do this on the chart. Okay, folks, we can go to the same chart, and if you look at that, we see basically, if you look at these, the first thing you need to do when you look at the candlestick crossing, you need to validate or invalidate the MA itself. So an MA that is touching the wicks of a candle, or is touching too many candles, okay, that MA is not valid for this crossing. So that is one of the technique that you are learning here. You will not learn other places. Okay, so when MA is touching a prices, that MA is discarded, is not valid for this signal, for giving the signal. Okay, but MA that is away from the price, that MA is the valid one to give us the signal. Okay, so if you will look at here, we see that, for example, in this case here, we see that, okay, here this blue one is 20 EMA, this green one is 50 EMA, and then this white one is 100 SMA, and that is 200 SMA. So So these two big one are SMAs, these two small the faster one are EMA, exponential moving average. So if we go for the we will try all those to validate and invalidate these MAs. Okay, so if we go here and we look at that, okay, oh, this MA is touching here the prices, so that is not valid, and this is far away, that is far away when we are at this stage for the price. And then the price have momentum, goes up and depart and get it goes away from the 20 EMA, and that is perfect. That is giving us a perfect opportunity to look at this vertical. So we will not look at this, we will not look at this, don't look at this, but we will go always from the faster down to the slower. So here we have the best here we have the best opportunity to look at that. And then we look at that, okay, here we have a candle, so we have a candle, oh, that crossed the candle and go above the price, that is perfect. So at this point we have a very strong signal to enter. Okay, so we basically we enter right here. So because why? Because these were below and then cross a red candle and went above, and that is a reverse of the trend. That trend will be reversed because and also we have very big what is called big candle here. And then once we have that, okay, we let it go, we write the position, and then we go all the way here. Okay, all the way here, and then we are here. So what is happening here? We see that once we buy here, we see that, okay, this is crossing that is crossing the second, third one, but it's not crossing the body. The good things with this technique is that when you see that, okay, an MA is here, you know, when the price is here is like this, you know, if I can tell you, if you need to think like this, you need to think like this. Okay, so when you see that candle, so when you see that moving average is crossing that one, okay, it's crossing that one, but is not crossing the body, that means basically you disregards these 50 EMA. That 50 EMA is no more valid for you to be used here as a signal. So you will look at for this one, okay, because this is just has touched that. Okay, we will look at that, okay. So now we are here. So we will know here, we will look at that, okay, whether we what will happen, whether it will bounce back or it will make a breakout. If you look at that again, MA it's touching that one and touching that one and touching that one, so we will not really consider that as a big signal. But look at that, okay, look at that, it's basically, look, we have of course our stop loss right here, because the one of the way that you can go stop loss, you go to the next high. That, okay, we'll see if now it will hit our stop loss now, but we cannot do that. We could have look at here as the support and resistance. So here we will have two possible signals here. Either it will break out more or it will go up. That is because we are now crossing that one, and then it's basically you have an engulfing, and that goes up, and the price is going up here, and then that will come falls down again. So that did not really hit our stop loss. But even if you can take your profit here, you can know that, okay, when that is happening, you have we said that when it get close to SMA, in that you have to possibly you will have you will have either signal, buy signal or sell signal. You always have a signal, so either is a buy signal or a sell signal when you touch MA. So in this case, you will either sell your what is called your asset, or you will still you believe that, okay, no, because that is touching too many candles, I will not see that, and I will let it go, and then it comes back all the way here almost to to the price that you bought it, okay, but it will not use a stop loss. But because of these rules that you did not really take this as because it touching too many candles here, so it goes up and then start falling, coming down all the way. The thing is that even if you assume that you have sold here, you have closed your position here. Let's assume that you close your position here, so you could here you were not getting good signals, you were not sure because these email close to each other, and then you let it go. You don't make any trade here because they are touching, they are just getting close to each other and making a knot here almost. So you let it go, and then you look at these from here to here, you see that this MA is making very good position for a new position, because it's far away from the price that's going up, and that cross here, that cross the body candle, and then that means basically you have perfect entry here. So you enter here. So once you enter here, you go all the way down with that, you come here. Now here, what is interesting in this case here, so you look at that here, either you will have a breakout or you will have a bounce. So you will look at that, either you close your position here, depends on you. But if it were me, I would not take the risk and position when it goes to such a places, because you don't know what will happen. But in this case, it has breakout, and then the breakout, so it did not bounce, it breakout. But assume that you have sold that there, and then you come all the way. So here there is no signal, so you cannot look at the MA for the candle crossover, but you can look at these MA, because that is far away. You look at that, if it's crossing, it is getting far away. And then no, we don't have we still don't have this. This is touching the 20 MA is touching, but 50 MA is going at good position for us, validated as a good indicator to give us the signal. We will follow that one. Okay, we will follow that one. Yeah, we follow that one. So it comes here. Assume that we sold that here. So because of this noise here, we don't worry about the noise. You cannot always hit the bottom and the top and the bottom. Okay, so now we are looking at this one, and we are looking where it will give a crossing. Oh, that give us a crossing here, the perfect crossing, and because that is far away, you at that. So we will enter here. So we will enter here a long position. We go long position here, and then we go that here, and then that is crossing. That is hitting a lot of wicks here of the candle. That is again we invalid this one. That is not valid, and then we let it go. We use this MA as our stop loss. So it goes up. Now we will look at this 20 MA. 20 MA is for in that stage is away from the price. That's good, and then touch the price, and then goes here, touch the price again, is invalid, and here it is valid again. It is valid because it is away from that price, and then we look at that. Oh, that crossover. What we will do, we will exit right there, because that basically at this stage you look at that this is away from the price, is not touching the price, and then it's it's basically crossing a very body of a big candle. So we exit there, and we will see what will happen. So we will exit there. So again here we have a very ambiguous and mixed signals here. We don't know what is happening. So it's basically here here we have a very special case that I am gonna to tell you what is that special case. If you look at here, we are the moving averages are making a knot. we're making a knot here, and then once you have this moving average getting close to each other and sticking to each other and creating a knot there, so you will only look at the faster MA. Okay, when you see that a knot is there, which is in this case we have a knot here, so that knot will be open. One of the you look at the fastest MA. Which one is the fastest MA? The blue one is the fastest MA, because the blue one is 20, this yellow one is 50, and that is 200, and that is 100. So because this knot here, there is a knot here, and we will look at that. Okay, the blue one, because there you will not, basically you will not get any of this crossing signal because it's very mixed. But at the same time, when you see that a knot has been built by MA, so you will look at that this faster the direction of the direction of the fast MA. If that fast MA goes up, that means basically the best signal is a very, very strong signal, because that is coming out from a knot. Such a knot situation is very, very strong signal, very, 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 very strong signal. Don't forget that. Okay, so what will happen here actually is that you look at the fast MA. Okay, here cross the knot. Okay, once cross the knot, then we basically enter here. So we will enter here. So if I just make a point here, because that is we will enter someplace here. Okay, because that's again then because that is a knot that is going from a knot that is very strong, and then we write that all the way here. So you see that we write it all the way here. Still there is a possibility that it's gonna go much higher. So what we learned here is that first of all, with the crossover, you need to validate and invalidate the MAs. If the MAs is touching the wicks and touching the prices, then that MA is not should not be considered for this crossover. You will only consider such a clean MAs that is crossing by clean MA, it means that when it's away from the prices, then you can use that when it goes past the candle. Sometimes you see that this MA here, that is not basically is invalid. Why? Because it's touching the prices. But this one no, so this one is giving us a good signal here, and that one again is giving us mixed signals. Why? Because that is touching here and then touching another week, now that is not really going. And then we go all the way here, and then the situation when a knot is being built by the multiple moving averages, and then that is the perfect place that a strong signal will be given you, and that signal depends on the fastest moving MA, and then that fastest MA, when it break out from that knot and take the direction, then you just write that direction. That direction is the very good one, and you can look at the volumes as well. Okay, the next one of the crossover is the moving average MA itself, when MAs are crossing each other. The first one was that when MA it was crossing candlestick, okay, and then we were required for invalidate and validate the MAs, and then we look at the knots, if there is any knot, and that breakout from the knots, it was giving you a strong signal. This is the common one actually, that you probably has already seen that many places and many videos about this, because this is very, very common. But the first one was not common at all. So here is that when is an uptrend, an uptrend is when an MA with a short time period crosses above an MA with long time period. Okay, for example, when 20 MA is crossing 50 MA from below to above, that is a uptrend. That is a signal for the uptrend. Okay, and then the downtrend is the opposite. When an MA with a shorter time period cross below an MA with a longer time period, it usually means that the market is in the downtrend, which basically means that, okay, the 20 MA is about above the 50 EMA, and then it falls, and then it across the 50 EMA, it goes under, and that means basically a bearish. Let's do this signal, and then let's evaluate the difference between this crossover and my crossover. Okay, we will make a evaluation of both crossovers. Okay, the first thing with the crossover, I will first talk about the crossover, then we will compare them with the my crossover. The crossover is that basically, if you look at here, we have the MA 20 MA is crossing the MA, so that gives us a very good signal. I will try to put just here. So basically, that is the signal we get. So probably we will enter someplace here. Okay, so that is where this blue one, the blue one is crossing the yellow one, which is the blue one is 20 and yellow one is 50. So the slower faster is crossing the slower under, and that means a bearish signal. That is perfect. That is perfect. That is going also the signal. And then when we come here, we see that, okay, I put another things here, that when you see that at this stage someplace here, so you get another crossover here. So that blue one is crossing that one, and then that one crossing that one, and so on. So we have a signal here, we have a signal here, we have a signal here. Okay, so what okay, that is perfect. That gives out the signal. That is, we can use this as a confirmation, further confirmation for our cross candlestick crossover. But look at that, what you see the differences here. Look, the difference is how fast is the crossover, the candlestick. The micro crossover is just right here. You enter here, but this one you enter someplace here. So you basically, that is what you are losing. You know that so this is basically the amount of fall that you are losing. So this is very crucial. So the things here is that is much faster. Even if you look at here, so the same situation, we enter that here. Okay, but look at that, you enter here. When we say they enter here, probably you have been entered here. So if I say that, so because the price is here, you are entering that. Okay, so if I just make it something like that. So again, look at that, the difference. What are the difference? Okay, the difference is that much. You know, this one mine is much faster than the normal crossover that people are talking about. That, okay, so what we will do is that once we can use this as another confirmation for our strong signal one. Once we enter here, we will look at that. If they crossing that, okay, then we will be more confident that, okay, the decision we have made it is correct. So it's useful. We don't say that it's not useful. It's doable. You can do it. Okay, you can do it. You can do other things with that as well. But you can use it maybe some confirmation for your signal. So why? Because the crossover, the candlestick crossover is giving you much earlier the signal. So even here, if you look at that, so here we have the not situation, and that was very special case. That special case, basically you cannot say here which one is crossing which one. So you go for my strategy that that okay, you look at the faster one. When the faster one is breaking out from the knot, you follow that direction. Whatever direction is, you just follow that direction. So that has nothing to do with the MA crossing, and has nothing to do with the candlestick crossing. Okay, so this is very special case. You see that in that case, in the MA crossing, you could not do it here, but so with my strategy you couldn't do that. So if I summarize here for you, my strategy is here. You have three things. One is that the crossing, the two crossing, that is the candle crossing and the MA crossing itself, and then the knot one. The knot one is, that means when all the MA is getting close to each other, and then you look for the fastest MA. When that fastest MA break out, you just follow, you just ride that direction. Okay, so three strategy you have learned here with this moving average, instead of just going for the crossing, you know, that one. And all of them, they are completing each others. They are very they are is like a puzzle piece that they are just putting if you put that all together in your trading plan, then it will be very successful. So that's how it is. Very simple and very powerful. Okay, folks, there are a few things at the end to tell you. Is very important to keep this in mind in order to these three specific strategy that I told you about the moving average. And I told you upon the completion of this course, you will learn a lot of tricks and techniques. So that was exactly what you just saw it. Okay, so the market respect to MA. Market sometimes does not really respect or get. So at times the market seems to respect MA support, resistance, and the signals, and at the other times it shows this indicator no respect. So keep that in mind, that you need to look at that. Okay, when it is basically when trending, when you have strong trending conditions, when you have strong the trend condition, then that give you very powerful signal that will give you really that will they be very good. And that is that but it works very poorly where in the choppy and ranging conditions, generating multiple trend reversal or trade signals. It is basically is generating a lot of false signals when the market is in ranging or the market is choppy, which means basically when the volatility is so high and the market does not respect MA rules at all. So these three things you need to keep in mind. Keep in mind that okay, market always is not respecting the MA, and also MAO also is work quite well in a strong trending conditions, but is working very poorly in a choppy and ranging condition. These three things you need to keep that in mind. And then now how to master how to master them. That is very important. I think this point is very important to be aware about that. First of all, you need to use that in different time frames to make sure that okay, things are you are seeing the whole picture. Is not going to small time frame like 5 minutes, 10 minutes, or 1 minute, and then expect that okay, it will give you the same the market would respect that 1 minute, or the market will not respect 1 minute or 5 minutes. You need to look at the higher time frames to get the bigger picture of that. Okay, that is very important. And then combine MAs with other indicators. That is very important. So like you can have a MACD, you can have a volume indicator there, you can have a ATR or whatever it is. It's always good that you get confirmation with other indicators. Always good to combine with the indicator. Don't just work that have only focus on the MA or just work with MA alone. So it's always good to get the confirmation from other indicators for your analysis. Okay, and then combine two or more moving averages. Of course, that's exactly what I had. I had 20, 50, and 100 and 200, and you saw that how easy it was to invalidate and validate that MA, whether this discarded or this not discarded, whether that touched the price or not. So that is very, very important, that you have the several moving average. And another thing is, when this knot is being built, that knot is giving you the best opportunity. Okay, you look at that. Okay, when the fastest one is breaking that knot, and how you will do that if you don't have multiple MAs. So multiple MAs is very, very is really required to have it, otherwise it's not gonna work. Use the volume indicator when trading. That is very good. You always if you have learned about the Gailani Q10 strategy, in that Q10 strategy you have 10 roles, and the role number 9 is basically is the role that tells you whether all those eight roles were valid or not. So that is very, very important. So the volume like that, if the volume is less than the normal volume, that means basically the signal that you are having is a fake signal. But if the volume is in the normal size, or is bigger than its normal size, then you can count down your signal. You can count that this signal is a good signal, otherwise it's a little risky. Trade breakout through the moving averages only if the volumes are high. As I mentioned, the volume is very, very, very important. Okay, one of the most important moving averages is 200 moving simple MA, significant psychological level. Yes, why? Because most of the traders, most of the trading supercomputers, and all the banks and everywhere, they are more using this 200 MA for identifying bearish or bullish situation for asset. Because this becomes a very common tool used by most of the traders, so that becomes a significant psychological level when the price get close to that, or is above that, or below that. The rule says this: if any asset that is below its 200-day SMA, then you need to avoid going long on that long positions in that asset. You need to focus on the short positions. When the asset is above its 200 SMAs, then you need to avoid short positions, but have focus on the long position. This is very, very important, and that's why it has a significant psychological level. Okay. Moving the other strategy, it is now that you need really, in order to make the moving average to be in your favor and working in your favor, you need really to make the trend your friend. You should never go against the trend. That's the rules in this market. Your trend, make trend your friends, and make the MA's trend your friend. Use MA's for a stop loss. You can use MA for a stop loss, so for exiting, for a day trader, or those who are trading hours, or very quick, they can use 20 MA for their trailing stop loss, or those who are mid-term, they can use for example swing traders, they can use 50 MA as their trailing stops, and long term they can use 100. And we said that 200 MA we use for identifying the bearish, the bullish and the bearish condition of that asset. That is for that significant psychological level that it has. And then we use these for entry filters, for entering and filtering the false signals. I have a strategy called lizard, which I will tell you in another video, and then the same with MACD and crossing. So I will have these in those videos. I will tell you how I am using the moving averages to filter the false signals in those for those indicators. Okay. Okay, folks, thank you for listening. We have come to the end of this course. I hope that was useful. I hope that you have got some good knowledge about some of the tricks and techniques that I promised you at the start of this course. I wish you good luck. Have fun.